Hi, we are Group 1 and we will be discussing a $29 million kickback scheme involving a Hartford County manufacturer. The individual in question is Eugene Denoto. He is a manager at a family-owned global manufacturer in Hartford County, Maryland, which will be referred to as Company 1. Company 1 is commonly uses drums and barrels as a form of storage and transportation for their products, which includes foods and cooking oils. From 2012 to 2020, Denoto orchestrated an overbilling scheme through his partnerships with fellow manager Elliot Kleinman and connections with local drug vendor Anthony Urcioli. Urcioli would submit invoices to Company 1 for inflated quantities of drums. The excess payments from Company 1 would be split between Urcioli, Denoto, and Kleinman. Overall, Company 1 faced losses of $29 million, $20 million of which was tied directly to Urcioli, and the additional kickbacks and losses were associated with Denoto alone through other murky dealings and failures to report. Overall, Denoto was sentenced to 70 months in federal prison and required to pay $19 million in restitution.
The overbilling kickback scheme involved two managers from Company 1, Denoto and Kleinman. They formed an agreement with Anthony Urcioli, who was the owner of two storage drum suppliers. Urcioli would submit invoices to Company 1 for inflated drum quantities, and using their management positions, Denoto and Kleinman would approve and submit the invoices for payment. The three of them would then split the extra payments, and Denoto and Kleinman would receive their shares via checks made out to companies that seemed to be legitimate drum wholesalers. Their scheme was uncovered when Company 1 employees found fraudulent purchase orders and invoices, which triggered an FBI and IRS investigation.
So here we've got a little bit of a diagram that just kind of shows the process of the fraud. So Denoto and Kleinman were managers at Company 1, and they would make weekly agreements to Urcioli to approve invoices for more drums than that they were actually going to receive. So Company 1 would order drums from Tunnel Barrel and Drum Co. and Hartford Fiber Drums, which were both owned by Urcioli. So then when Company 1 would pay for the drums, there was excess money which Urcioli would receive, and then he would split the payments between Denoto and Kleinman using their businesses EDK Management and Sandpiper Enterprises. Those two companies were fake and were registered at each individual's respective residence. They made corporate bank accounts to receive the money, and Urcioli would make the payments via check, and they were labeled as payment for drums to make it seem legitimate. Urcioli was able to, or in their agreement, he kept 50% of all the excess money, and then Kleinman and Denoto had a 25-75% split on their share.
Alright, so the primary accounting issue here is the overstatement of expenses resulting from fraudulent invoices for industrial storage drums that were never received. So under ASC 330-10-30-1, this was inventory. The primary basis of accounting for inventories is cost, and more specifically, inventory cost is the sum of the applicable expenditures and charges directly or indirectly incurred in bringing an article to its existing condition and location. So because the company paid for drums that were never actually received, the costs were not incurred to bring inventory to its existing condition and location, meaning the payments did not qualify as inventory costs and resulted in misstated expenses in the financial statements. And then to go along with that, we also looked at ASC 330-10-35-1A. So this noted that the subsequent measurement of inventory depends on the cost method. So in this case, the goods did not exist at all, meaning the recorded cost was not a legitimate inventory amount subject to subsequent measurement. but instead a misclassification that overstated both inventory related expenses and the total operating costs.
Finally, for controls and recommendations, segregation of duties and system controls are important in this case and could have prevented or made the fraud more difficult to commit. Kleinman and Denoto negotiated the purchases, prepared purchase orders, approved invoices from suppliers, and authorized payments before they finally sent the invoices to the corporate headquarters to be made. The responsibilities of approving purchase orders and approving invoices should be separated. So, for example, if Kleinman only approved purchase orders and Denoto only approved invoices, it would at least require collusion for the and make it much more difficult to execute the scheme. Additionally, a three-way match could have been enacted to match the purchase order, the invoice, and receiving documents. Any discrepancy between these documents would have immediately raised red flags, and the difference and overbilling of these shipping drums would have been investigated. Thank you.